Hey everyone, Mortgage Nerd here. Want to give you a rate update, but go over a few different things. One being that yesterday was one of the 5 worst days in over a decade, the worst since March 2020. Another thing we'll go over is the correlation between the 10-year Treasury and the 30-year fixed rate mortgage, and how those two are a little bit further apart than usual, so what that means for the future of rates, and also look at some charts on where the rates are now and where we think they're going to go. All right, so yesterday was terrible. Drove me crazy. I had to take some time off to relax because rates were really going crazy. Mortgage bonds were going down, 10-year Treasury going up, as you could see here. One of the 5 worst days in over a decade. And at one point, it was the worst day in nearly 20 years, with the exception of one day during March of 2020 with that volatility we had during the lockdowns. So here you can see what happened really Friday of last week, June 10th. We broke through this resistance level. And then yesterday, Monday, was really bad. So today we're leveling off, which is good. I'm glad to see that we're going to level off. Maybe we'll enter a range in here in the mortgage bonds so rates won't go up more. At the same time, 10-year Treasury. Remember, 10-year Treasury, as that goes up, rates go up. That broke through an important level that we haven't passed in a while, but at least we're stopping, and hopefully we enter a range up and down over here as well, going sideways. Here's a historical chart talking about the relationship between the 10-year Treasury that I just showed you, a more recent chart on it, just the last few weeks, and this one is of the last 50 years. So 30-year fixed rate mortgage, the average spread between them is 1.7. What does that mean? So right now the 10-year Treasury is 3.3%. So you would say if 1.7, that means mortgage rates should be 5%, but they're not. They're much higher. So here it says the average spread over 50 years is 1.7. But look at where the average spread was earlier this month. It was 2.2%. Now the 10-year Treasury is at 3.3, as I just showed you. So if you add 2.2, then the average mortgage rate should be 5.5. It's probably a little bit higher because what happens is the lenders are overestimating, they're overpricing these, they're raising the rates to pack in the potential of rates being even higher in the near future. So they end up pulling these back and scaling them back when things calm down. That's what happened over here. A few weeks ago, rates went down into the 4s again. You didn't hear a lot about that, but I was locking in my clients at that time. And then since then, it's been a free fall of mortgage bonds, but a rise in the 10-year Treasury. So now hopefully later this week, the Fed announces a larger interest rate hike on the Fed fund rate, which will fight inflation. The Fed raising the Fed fund rate fights inflation, helps mortgage bonds, brings long-term mortgage rates down. That's what happened in May. In May, rates started going down, fixed rate mortgages that is, and that's because we were fighting inflation by the Fed raising the fund rate. And that's what we hope is going to happen later today. They've been estimating 50 basis points, 0.5%. Hopefully now it's going to be 0.75 instead of just 50, 75 instead of 50. And that'll be even more aggressive. And all of this is because of the news of higher inflation last week, which really wasn't much worse than expected. It was just a little worse than expected. Mortgage Nerd out. Thanks.